Sorry, as in I have 3 networks active now, but just messing up today. Sorry, Celestina. Thanks for the discussion. Do we have any comments from anybody on any reactions? It seems like we won't go far tonight.
Well, let's try and finish up. Let's try and finish up.
Okay, let's move. Let's plan. Okay, company income tax act. Deletion of incentives such as rural investment allowances granted to companies that provide certain facilities such as roads, etc. I've always known these particular provisions in the act. You know, if, for example, I'm investing in, let's say, my village, and where I have a large acres of land for farmland, no roads, no electricity, nothing, and I provide for the road, you know, wire the place up, I have some incentives. But now, since I was in university, I've known this investment allowance, you know, now it's being removed. What could be the reason for this?
Okay. So for me, I think the reason for this is that maybe the lawmakers, they consider it as redundant or maybe double dipping. Okay. And I will explain why perhaps it may be construed as double dipping. So if you recall, I think in 2019, the president issued the Road Infrastructure Development and Refurbishment Investment Tax Scheme 2019. So literally what that scheme does is that if you incur any project cost in the construction of eligible roads, so you're entitled to recover 100% of your project cost, 100%. But for every year, I think you have a cap of 50% of your CIT for every year, up until when you completely deplete the whole project cost. So if you look at it from the perspective of one of the targets of the rural investment allowance is when you invest in areas where there is no road, you may consider this as a repetitive. You may consider it as a repetitive or double dipping, right? So maybe they decided to take it out to then have people make records to the new, I won't say the new because it has been there since 2019, the Road Infrastructure Development and Refurbishment Investment Scheme. But I won't necessarily also say that is completely, I won't completely say that it's double dipping in that sense. Because if you recall, under the rural investment scheme, you still have issues around electricity if you're investing in areas where you don't have electricity. So it's not just limited to road, right? So you have, if you're investing in areas where there is no electricity or there is no water and the like. So it's not just road. So whereas an aspect of that road has been solved under the Rural Infrastructure Development and Refurbishment Scheme, the other aspect has been taken out because at the end of the day, we no longer have that kind of incentive. Another justification for this is that they feel that it's a bit redundant in the sense that there is no place that you go today that doesn't have lights. Particularly when you look at the constitution, that the states now can develop their own infrastructure assets. I mean electricity assets, right? You can have mini grid in your village everywhere. So to speak, maybe it's difficult to say that there is any area where you can go to that you would say that quote and unquote that there is no lights. You may have one or two, but in terms of the magnitude, may not necessarily. No, I'm saying that I'm just trying to be. I've played the devil's advocate to come up for justification. Okay. I'm playing the devil's advocate because I think they took it out because they felt that it was redundant. To be honest, that was why they took it out, and they also took it out because they felt that some of the matters discussed therein is being solved under the Rural Infrastructure Development and Refurbishment Investment Tax Scheme. And I said earlier, that scheme is just for road infrastructure, right? It doesn't cater for areas where there is no light or where there is no water and where there is no public amenities, quote and unquote, which is something that you have under the Rural Investment Allowance. So I think that's generally the justification for what they've done. But as to whether what they did, whether it's right or wrong, I guess for me, I would just say that partly they solved the problem, but we still have other parts of it that have not been addressed, particularly because you have a lot of, particularly because in the power sector, I mean, you have a lot of people that will go and put up, that will indeed incur infrastructure costs with respect to mini grids developments. And that's the kind of relief that they will ordinarily fall back on before. But now they can no longer fall under that kind of relief. The only relief that they can fall back on is if for any reason they're also constructing roads around that area. So that's just the limitation.
Okay, so if I power my plants empower the community that gave me the land for the plant. I do not qualify for any relief anymore, except I build a road.
Unfortunately. So that's the situation that we have, unfortunately.
Okay.
You fall back to your normal capital allowance.
Now, I buy plants. The plant's supposed to generate power for me. And before now, in the old regime, I have access to 10% investment allowance on that capital cost. Currently now, that has been repealed as well.
Yeah, so I think the justification for this.
I think it's unfair to the taxpayers, because now you removed the rural investment allowance act, and you've also removed the capital allowance on plant and machineries. That investment has always been there. That enables the taxpayers reduce their taxable income at the end of the period, right? Now that has been taken away also. So I'm just investing in capital assets, providing life for myself, and still paying these taxes. I think it's not a way to try to encourage taxpayers, or also try to help businesses to survive this economic. I don't think it's proper, actually.
I agree. I agree. So with the investment allowance, I mean, as you rightly said, investment allowance with respect to plants and equipment is the only allowance where you would have like 110% allowance generally, because you have your capital allowance 100% and then you have your investment allowance 10%. At the end of the day, you're entitled to 110% allowance. So I would assume, I wasn't part of the people that drafted this anyways, but I would assume that
your friend was there. Go ahead.
I would assume that the reason why they took this act was to just provide for 100% allowance for any capital expenditure, right? That's one. Two, I think because of that word, plants and equipment, is broad enough for people to bring in a lot of things underneath. So I think in the past, it would appear that some persons have abused it, and there has always been these debates in terms of what would qualify as plant and machinery, or plant and equipment rather, because a lot of capital expenditure can be brought under plant and equipment.
Generator
exactly. A lot can be brought under plant and equipment. So I would imagine that because of the magnitude of this allowance that people have been claiming under this head, perhaps they felt that let's just do away with this thing, because I guess that was why they took it out.
I think that they're employing so many accountants who have been in practice before.
Oh, I see.
Yes, and they are doing a lot of it because they've been there. Someone like me now going to FRS now. I've practiced tax for over 8 years as an auditor, and we know those loopholes where you can do tax planning, right?
Exactly.
And
yes.
how you can leverage on those lacunas in the act. So I think they're going to strengthen the act in the sense that you can no longer, it's no more free for all anymore, where you can begin to look at areas, because I don't want to say much here because actually tax planning, is very critical in terms of capital allowances.
Exactly.
A lot of firms use that area to, reduce their tax exposure to the government. And I think what is going on right now is that we will see more of these things. We'll see more of this act strengthening in a way to reduce how people abuse these sessions.
Exactly.
And again, they also bring a lot of argument with tax authorities doing all tax audits. You argue a lot in terms of what, for example, the issue of self-assessment or self-charge for VAT is still an argument now. Even though they've issued circulars to explain what they mean, right? Lawyers, tax practitioners still find a way around all those kind of acts. So I think we'll see more of these changes going forward in our tax policies.
Yeah.
I'm tempted to just jump all this because we are just 10 minutes away from.
No, so I think for shipping, shipping, I think it's important that we highlight shipping. So the amendment that was done with respect to
air transport.
Yes, shipping and air transport, because I think is one of the tropical issues that we have presently. If you recall, they've been in the news lately. I think in 2021, the FRS issued a circular to all international shipping and air transport companies to regularize their tax status, right? So, and another circular was issued in May 2022. And this year, the FRS then issued a demand notice asking them to pay their tax for the period of 2010 to 2019. And that caused a lot of panic in the sector. So the present president.
Sorry, hold on, please. Now, this issue now, discuss it in line with NRCs, right? Shouldn't the provisions for NRCs cover these returns as well?
So I mean, I think that would be with respect to compliance generally. So that's part of what the compliance in terms of the amendment that was done. That was part of what they've addressed. Now, before I go to the compliance bit, so because of what the FRS did, or the demand notice that was issued, so there was a lot of panic in the sector, and the president there had to step in. The president stepped in and then issued a grace period to December 31st to have them regularize their tax status. Some of them had to withdraw their vessels from Nigeria, right, because of the magnitude of the demands of the FRS. Now, in terms of the specific amendment that was done in the Finance Act, what the Finance Act did with Section 14 is to specifically require the regulators, so NEMASA and all regulators, to demand for TCC, your tax clearance certificates, or evidence of tax filing of these shipping and air transport companies before they can grant any permit or approval. So there is this statutory obligation on them now to demand for all those permits, to demand for your tax clearance, your TCC, and your evidence of tax filing before you can even do any business in Nigeria. So your regulator will ask you to go and get your tax clearance. And if you're going to get your tax clearance, that means you have to be compliant, right? So that's the amendment that was introduced in that act. So there has been a lot of discussion in that regard, and that was why the president had to step in. But we'll see how this pans out, because I think a lot of them now are approaching consultants for advice and essentially engaging the FRS to see how to amicably resolve this. For those who cannot bear the liability, they decide to withdraw their vessels from Nigeria. I mean, because we are looking at a period that perhaps we can say that the statute bar, if you want to look at the limitation for tax for tax purposes, right? So I mean, there is even a lot of legal debates around what the FRS has done, but that's a discussion for another day. In terms of some of the legal issues that may be thrown up by that provision.
But I'm still on the point of non-resident companies. When they say international shipping companies, I understand it should be companies not registered in Nigeria, right? But having operations in Nigeria. Hello? Hello? Can anybody hear me? Can anyone still hear me? I think we've lost Celestina somewhere. Okay, we've lost Celestina somewhere. We'll just proceed with the yes, we've lost her. It's almost 9 p.m. and we can't extend more than 9 p.m. What this means for us is that we might either have to continue next time, or we continue some other month. All right, so let's move to the next item, which is actually pretty simple. The EDT from 2.5% to 3%. It used to be 2% before. It was moved to, sorry, I think she's back. Just hold on. Can you unmute yourself, Celestina?
Okay. Apologies, I lost connection.
Sorry, I understand. So I've jumped that ship. I left that ship.
Can you hear me now?
Yes, I can hear you clearly.
Okay, no problem.
So we've moved. This one is pretty straightforward. They keep increasing this tax, So we're now at 3% now. Just take note. Change your tax computation sheets to accommodate these 3% now. Let's move on to custom duties. Should we dwell on this or just jump to VAT because of time? Personal income tax act. We can have
we can actually move to VAT, but I think the only takeaway part of the executive orders that Umar mentioned also has an impact in terms of some of the amendment that was made with excise duties. If you recall, in 2020, there is 5% excise duty that was imposed on telecommunication services. And what the amendment of 2023 did was to extend that excise duties to other services, so beyond telecommunication services. Now, this particular provision has been suspended by
Tinubu,
present president, and the whole essence is just to consult more with stakeholders and see what indeed will be more ideal in the situation. So this provision has been suspended just in case we are advising telecommunication companies, and we had this as part of our rule book. So we should also have it at the back of our mind that 5% excise duty has been suspended. So you can carry on. We can move to that.
Okay. So Peter, just the issue of it was there before, the issue of premium on insurance. It was there before, it was taken out, and it was now introduced again, as part of your tax deductibles. So let's move on to PPT. Let's jump that one to VAT. Okay. VAT is the new oil now, and charging and accounting for VAT on goods purchased from an online electronic or digital platform operated by a non-resident supplier. This one is very important to me. So I go online from, let's say, AliExpress, or from any shop in Amazon, and I buy there, right? And they are not in Nigeria. How do I account for this VAT? Am I supposed to do anything, or the company itself will charge VAT on their invoice and remit to Nigeria? Because my understanding about non-resident companies basically is, if I buy from a company abroad and they issue me an invoice, I am to self-charge for that VAT, withhold it, and remit to the government using from O2. So in the case of online purchase, how do we account for VAT in terms of online purchase?
So Umar, if you look at the new section 10, the revised section 10 of 2022 Finance Act. So if you look at that provision, you will notice that it specifically empowers FIRS to appoint non-residents as an agent for the purpose of VAT collection. So what that means is that on a case-by-case basis, FIRS may decide to appoint an online business operator as an agent of FIRS to indeed collect VAT on the transaction involving yourself and I, right? Or the transaction involving their non-resident party. So what 16 sub 3 does is to say that where there's an appointment, so where FIRS indeed appoints a non-resident party as an agent or as a person that will account for VAT, then that means I'm no longer required to self-account. Me as a consumer in Nigeria, I'm no longer required to self-account. What that will mean is that I'm going to go with the evidence of that appointment. I will take it to the customs, and I will tell them that, sorry, for these goods that I want to import into the country, FIRS has appointed this online operator to account for that in that circumstance. And with that evidence of that appointment, they will allow me to import my product, right? So it's not an absolute regime where you're supposed to self-account, no.
Okay, so it's looking more
where FIRS has appointed them as an agent for FIRS purposes. So I think further to that, FIRS issued a circular, was it VAT simplification circular for non-residents. And pursuant to that circular, they've appointed a lot of e-hailing platforms as agent of as a VAT collection, quote unquote, agent for FIRS. So I even know that there is a decision with respect to the interpretation of that provision, right? But the point I make is that regarding this provision is not only in instances where FIRS has appointed a non-resident as the appropriate person to collect VAT on all his. Then in that situation, as a consumer, when I'm going to clear those products, I'm not supposed to pay VAT. I will just go with the evidence of that appointment, and customs will allow me to clear the products.
Okay. let's move on. So the act also amended the definition of building, in sense that any for VAT purposes, any items like features, structures, marks, all these television marks, transmission marks, cell towers, mobile homes, caravans, whatever it is that can be moved is not part of the building for VAT purposes. So it means that when you are saying no VAT on building, it does not include items that can be easily moved away from that building. Such items are not exempted for VAT purposes. I think it's just to amend the definitions of what building means in terms of VAT purposes. Any comments on that?
Yeah, for me, I think this is quite unfortunate, because particularly when you look at it from the perspective of the telecommunications sector, I mean, you know that the telecommunications sector is almost like a cash cow for the revenue authorities, because of the nature of their business model. These guys have like their mouths in all over the states, and everybody's trying to tap into their revenue. It's quite unfortunate, because this has always been their solace in terms of not putting VAT for some of their transactions. But now telecommunication mass has been taken out in respect of the definition of building. What that literally means is that all telecommunication services will now be VATable, unfortunately. I mean, I really don't know where we are going from in terms of this amendment. That's for me, that is not really encouraging broadband penetration in Nigeria, particularly because these guys, they've already been subject to a multiplicity of taxes, even at the federal, at the state, at the local government level. And I see no reason why we should be taking away this exception, this exemption that they have.
So you now bring us back to what I raised earlier on, that the FRS and the government are trying to ease off or trying to harmonize taxes in some simpler areas, while amending some areas that will greatly impact some sectors. It's like giving you food on one hand and taking that food from you from the other hand. So what they're doing actually is looking at areas they can adjust just to generate more revenue for the government, and that's not necessarily to help the taxpayer, lessen the burden of a taxpayer, because whatever they're doing here is going to impact on the profit, of the taxpayer.
Exactly.
Okay. So VAT due filing date is pretty straightforward. 14th of the next month, every VAT appointed agent is supposed to submit their VAT returns for all the VAT they withheld using Form O. So for those that don't know, there are four conditions.
This is a bit different. No, this is a bit different. I think I need to clarify this. So this section 14 is different from section 15. And for me, it just goes to the point of why the dichotomy, why the distinction. So section 14 is a provision that deals with FRS appointed agents. So that is where FRS decides to appoint someone to collect VAT. So where that particular right is exercised by the FRS, then you have up until the 14th day following the date of that transaction, from 14 days of the following month to account for VAT. But the default mechanism is 21 days for others.
21 days, yes, yeah.
Yes.
So I also think, this is a but. Can you hear me? Can you hear me?
Yes, I can hear you.
So I think
I can hear you.
Yes. I think this is a burden. This is a burden on taxpayers. First of all, you've appointed me as your VAT agent. Now you're giving me conditions. Time condition between, as in, you are using the time for me to now submit those VAT to you. So I don't think it's actually a welcome development for these guys who have been made VAT agents in a real sense, because 21 days is enough pain already to meet this VAT.
Exactly. So why are you breaching the time?
Yeah. So somebody asking the question. Let me look at that section. That has to do with self-charging. Now, I think there are 4 conditions they gave in the circulars. One condition is where a vendor who is not up to the threshold of charging VAT, then you have to add VAT to that invoice. What it means is that if a vendor supplies goods and services to you that are VATable and they are not up to the 5 million threshold where they can give you a VAT invoice, the burden of VAT is on you as a customer to self-account for that VAT and remit. That's one condition. Second condition being the fact that a supplier supplies
you
goods.
know, sorry, Uber. This is the one that we are always having interpretation problem.
I'm coming. Cool down. I'm coming. I want us to end with this argument. I'm coming. Now, the second condition is where the the supplier supplies goods and forgets to add VAT. Maybe the supplier is up to the threshold of adding VAT, but forgets to add VAT, then you have to self-account for that VAT. The fourth one is a non-resident company, you know, that supplies goods to you from outside Nigeria. You have to self-account for that VAT. And the fourth one, which they also mentioned, is where you've been appointed as a VAT agent, right? Now, the point is, which I'll let you to speak on, the point is, if, for example, the customer and the vendor, they are both not of the thresholds to administer VAT, should the customer, who is also an SME, self-account for VAT? Because in my understanding, the essence of self-account for VAT is to reduce the VAT burden on SMEs in terms of administration, going for tax filing, getting a consultant or enough staff to, you know, manage tax administration. So if the customer is an SME and the vendor also an SME, and that transaction is VATable, what happens to that VAT?
Okay, so first off, I think from a legal standpoint, looking at the black letters of the law, in terms of how these SMEs VAT treatments would work. So first off, if you're an SME and you have essentially your VATable supply is less than 25 million, right? You're not required to issue VAT invoice. You're not required to file VAT returns. Quote and unquote, you're not required to register for VAT. Now, the reason why I had to qualify that is that your restriction of VAT for VAT is already integrated with your CIT. So that one is indeed not an exception. But generally, you're not required to issue VAT invoice. You're not required to serve as FIRS agent for VAT collection purposes or file VAT. Now, the underlying transaction on the face of it, there are arguments as to whether the underlying transaction is indeed exempt from VAT. Because the whole essence of that provision is to remove the administrative bottleneck on the SMEs to act as FIRS agents. Now, the corollary question is whether the goods supplied by that SME is indeed VAT exempt. On the face of the law, it doesn't seem to be VAT exempt. But who should account for VAT is now where the issue is. On the face of the law, in terms of who should account for VAT, in my own opinion, I would say that is those that FIRS has appointed under Section 14. If FIRS has not appointed you, you don't have any responsibility to account for that because there's no provision under the law that speaks to that.
So are you saying I should dish their circulars?
No. The point I'm making is that I'm looking at the black letters of the law. I'm not saying that I should dish their circulars. So there is a commercial standpoint and there is a legal standpoint. Because to me, I would argue that circular does not draw validity from the provisions of the law, in my view. Because what the amendment that they've now done, what it does, what the amendment now does is to enable them to appoint persons on a case-by-case basis. And that's why you have Section 14. So if, for instance, I have a situation where I'm transacting with SMEs and that SME is not required to account for VAT, FIRS can exercise their powers under Section 14 and tell me to account for VAT as the consumer, right? And they will argue that because the underlying supply is not exempt from VAT, so I have to account for VAT. That's what they will argue. But in instances where I have not been appointed to account for VAT, there's no provision that perhaps give credence to the fact that I should indeed file VAT returns on that consumption, even though I agree that there is also no provision that says that it's VAT exempt, right? But for me, the way they've treated this, in my view, is to allow FIRS to make that appointment. So until FIRS writes to me and tell me to account for VAT, I don't have that obligation to account for VAT, in my own view. Now, from a commercial standpoint, it may decide to self-account if you so desire, right? But me, I would say that for the provisions of the law, I need to be appointed before I will account for VAT. If they've not appointed me, I won't account for VAT from the provisions of the law. And that's exactly why. Just think about it. If that is the position, then they won't need Section 14. Why did they amend it to include this kind of provision? It's just to give room for them to make that appointment, right? And to cater for this kind of nuances that we are seeing. So until they make that appointment, in which case I'm not going to bear any liability in terms of historical penalties. I will only account for VAT from the date of that appointment. That's what it means in terms of that Section 14. But From a commercial standpoint, I may decide to go and step accounts. And is what is, on the commercial standpoint, I may take a commercial decision and say, I just want to file. I don't want to have any issues with the FRS. Let me just go and step accounts. Now, the second part is when you have two SMEs, right?
Yeah.
Now, I said that is the supplier SME that is an issue and not the consumer SME. So if you have a supplier SME, the supplier SME is the supplier SME's threshold that is being referenced under the Act. So the consumer SME is irrelevant, threshold is irrelevant for that purpose. Yes. So it's the same rule that will apply. So if the supplier,
I think so. I think if that happens, then the whole idea behind the threshold is defeated. Because we are looking at now the body now moves to the consumer, who is of the same threshold with the supplier.
So that's exactly why I said that you're not required automatically to account for that if the supplier is below that threshold, right? It's only when FRS appoints you. So if FRS
that means that transaction is not vatable.
It's not like it's not vatable. I would say that the payment of VAT is deferred. It's actually you are using deferred payment until when FRS appoints you. If they don't appoint you, you put the money in an escrow until when you are appointed. But the point I make is that's the argument that FRS will always use. The argument that FRS will always use is that the underlying product is not VAT exempt. That's what that's the argument that they always use. I agree that it's not VAT exempt. But in terms of who should account for VAT, the only provision that in our own law is when FRS appoints you. If FRS has not appointed you, there is no provision, there is no fallback mechanism that requires me to step account for VAT in that situation. When I'm not a non-resident, there's no mechanism.
So but for non-residents, we can still step account for VAT.
No, for non-residents, yes, you have to. You have to.
Where they've not appointed me as a VAT agent.
No, so for non-residents, it gives FRS like you have it has different scenarios, right? So it requires a counterparty to indeed step account, but the counterparty will not be required to step account if FRS has appointed a non-resident. So the counterparty is required to step account, but that obligation will not arise if FRS has appointed a non-resident. So that's the way the Act is worded.
Okay, I think we are 14 minutes behind time already. Do you have any comments from anybody? We can't continue with this session.
I think there's a question. I think there's a question around. Let me see. There's a question around the exchange rates.
Okay.
Exchange rates. Yeah. So I think for me, the only thing I would say is that with respect to the exchange rates, for instance, if you look at the provisions of, I think the withholding tax regulation and even the circular that FRS issued, and I think the provisions of the VAT Act, I'm not sure because looks like that provision was also amended. It used to be in section 10, but I think it was also amended. But I think there's an FRS circular that essentially says that you actually account for tax in the currency of the transaction, right? So what that means is dollar for dollar. So if you collect dollar, you pay dollar. But I think the more problematic point is because of the fluctuation in exchange rates. So even though you want to quote and unquote, you want to convert, it is advisable that you use the rates at the date of filing, not at the date of the transaction, at the date of filing. Because if you use the rate at the date of filing, because that's the only time the FRS will query it. If you use the rate at the date if you're not paying dollars, for instance, and you decide to pay Naira, and you use the rates at the date of filing, and I think at the end of the day, quote and unquote, I think you've done what you're supposed to do because indeed you've converted at the date that you're filing their returns. But it's usually a problem if you use the rate at the date of the transaction. That's where FRS will flag it. So it's either you're doing dollar for dollar, which is exactly what the circular says. And I think the withholding tax regulations, I think it has a similar provision. VAT Act, I think there used to be a provision like that in section 10, but it looks like that provision was amended. It looks like it was amended. So, but the point I make is that, so err on the side of caution, use dollar for dollar based on their circular. But if you're not going to be paying in dollars, then you have to use the rates at the date of the payment of the tax and not at the date of the transaction. Because if you do that, that means FRS is going to flag it and they're going to tell you, and they're going to raise additional assessments in relation to the difference, right? Yeah, so I don't know whether I have answered that question. I think that's the only question I can see that will be answered.
I think so. We've answered the other one on VAT, withholding of VAT. This one on stamp duties is just showing formula. Let's move on.
Okay.
I think that should be all that concerns us. This is public sector. I have no interest in these ones. No interest. Okay, that's all from our end, actually. Any questions, reactions? I think Tina has done justice to most of our discussions. For me, my take home from these ones are basically on the issue of the company income tax, capital gains tax, and the VAT issues. That my take home from this Finance Act. I think as the day goes by, we'll see more of this adjustment to tax policy to bring more people into the tax net, or is it to bring more people into the tax net, or to make people that are already in the net pay more taxes?
It's a combination of both.
Both. Okay, because those I have a client who is actually frustrated, as in he faces audit every year.
Wow.
Meanwhile, there are people that are not even in the tax net in the first instance. I won't call regions. There's some regions that just doing business, not in the tax net at all. Meanwhile, other regions, the guy is being audited every year. They come for tax audit. So I think while looking at expanding tax compliance and tax payment, also look at how to extend the tax net to accommodate the non-formal sector, where you have more people coming into the net and not suffocating those already in the net. Let the taxpayers breathe. They're already in the net. You have their tax details, you have their CAC, their TIN, and you are still suffocating them from the one they have. You see companies being sealed up, So why not work on bringing more people into the net, as against working on frustrating those already in the net to pay more taxes? By removing some incentives, you mean that paying more taxes to the government. And I think it's something you need to look into. Thank you so much, everyone, for coming this week. Thank you, Tina, so much for making this sacrifice again. Please, I don't want to go into other course of business, please, Vincent. Let's not go into that argument now, because that argument is huge. Let's not go into the argument now. You deduct returning taxes from hotel invoices, from those supplying to you, selling to you. So the argument is very, I think there's some court judgment on that argument in terms of
the Tetra Pak.
Yes. So let's not go into that argument right now. Maybe for next time. Thanks everyone. Thanks, Tina. Wish you a very lovely week.
Everyone.
Very lovely week. This has been very educative and impactful, and we are glad to always bring you back on board. So, but we'll give you a break for the next 2 months. I'll call you again. Thank you. See you again next week, hopefully. Hopefully we'll see you again next week. Cheers and have a wonderful week ahead, everyone. And God bless you.
Goodbye, everyone.